Gold just hit $4,000 while oil crashed to $89. That split means your safe place and your fuel costs are doing opposite things right now. Heading into the new week, Sunday, July 26, 2026. Like and subscribe for daily market updates. Today's agenda: week in review, market snapshot, oil price drop explained, gold rally context, crypto market update, stock market outlook, what to watch next week. Up next, market snapshot. This week in markets, Bitcoin held near $64,000 while Ethereum gained 0.4%. Gold climbed to $4,070 despite surrounding noise, whereas silver lagged behind. The S&P 500 closed flat on Friday after big tech stocks like Microsoft and Meta disappointed in earnings. The Nasdaq slipped 0.6% as AI spending worries lingered. Although the Dow recovered slightly, it remained weighed down by oil prices surging past $96 per barrel earlier in the week. Global political tension kept crude elevated, pushing Brent near $100 even though war premiums stayed contained within energy markets rather than spilling into airlines. Yet, that matters significantly because fuel costs eat profits everywhere, ranging from shipping lines to grocery stores. Central bank signals remained quiet until Wednesday's Fed decision loomed large over everything. Investors watched closely for any shift in policy direction that could alter the trajectory of equities and bonds alike. The broader economic landscape continued reflecting uncertainty regarding inflation trends and their impact on consumer spending power. Supply chain disruptions also played a role, affecting inventory levels across multiple sectors. Meanwhile, corporate earnings reports provided mixed signals about future growth prospects within various industries. Market volatility remained high as traders adjusted positions based on new data releases and geopolitical developments. Currency markets reacted to shifting interest rate expectations, with the dollar index fluctuating against major peers. Bond yields moved in tandem with inflation fears, influencing fixed income strategies globally. Real estate values faced pressure from rising mortgage rates, impacting commercial property valuations significantly. Commodity prices reflected both supply constraints and demand dynamics across different regions of the world. Overall, market participants navigated a complex environment filled with competing narratives and conflicting indicators shaping investment decisions daily. That brings us to oil price drop explained. Here is where things stand right now, heading into the new week. Bitcoin sits at $64,317, with 0.01% change basically flat, but coiled like a spring waiting to snap. Ethereum trades up 0.4% at $1,880 after pushing toward $2,000 resistance today. Gold is higher by 0.05% now, sitting right here at $4,070.80. Silver hasn't caught its breath yet compared to gold's recent bounce. Oil just dropped 3.88% down to $96.7 for Brent, while crude oil sits lower still. The dollar index is holding steady around 101.47, with no real movement either way right now. Which leads to gold rally context. Why did oil prices tumble 3.88% today? To many participants, this move appears excessive because the war premium remains confined to crude futures rather than spilling into airline stocks or broader logistics sectors yet. This disconnect highlights a critical mechanism. Traders aggressively front-run anticipated rate changes and global political shifts before central banks officially acknowledge them in public statements. The financial system operates on whispers that precede headlines, causing unpredictable price swings to spike ahead of confirmed data releases. If Iran were suddenly cleared for selling dollars, the repercussions would be immediate and severe, shaking airline stocks overnight as fuel costs erode profit margins across shipping lines, grocery chains, and retail giants alike. We must scrutinize whether this current calm represents a genuine de-escalation or merely a temporary lull in global political tensions that continue to simmer beneath surface waters. History offers context. The 2014 drop saw oil collapse as global political fears subsided without immediate conflict triggers, only for prices to rebound violently when new instability emerged from unexpected quarters. Conversely, the early 1970s demonstrated how supply shocks could persist long, after initial diplomatic resolutions were announced due to lingering market skepticism. The current price action suggests that prevailing supply fears may be overblown, unless a fresh conflict trigger emerges soon enough to reignite panic selling. Investors holding energy portfolios face an immediate decision. Is this dip a buying opportunity based on fundamental oversupply, or a trap waiting for the next global political flashpoint? Those betting on sustained lower prices must monitor diplomatic channels closely, as even minor escalations in Middle East tensions can reverse these gains instantly. The market's current pricing implies confidence that no new wars are imminent, yet history teaches us to respect the thin line between peace and chaos when oil is involved. Here's crypto market updates. Gold climbed 0.51% to settle at $4,080 per ounce today, a move achieved despite the persistent drag of rising real yields, which continue to suppress non-yielding assets like precious metals. Real interest rates remain stubbornly elevated above 4.5%, creating significant challenges that prevent gold from rallying further until inflation expectations cool or central banks rate change policy significantly next month. This price action appears somewhat overextended given that the US dollar index has not yet broken decisively higher, a technical prerequisite often seen before major asset a repricing of expectations occurs. Consequently, it is highly improbable we will see a fundamental shift in market investor mood toward gold by Friday, unless an unexpected global political event forces investors to abandon risk assets overnight for safety. Historically, similar yield environments have preceded periods of choppy trading rather than sustained bull runs, when the dollar remains strong. Notably, during 2018 and early 2023, gold struggled in high-rate regimes until yields normalized or external shocks intervened. The mechanism here is clear. Higher real rates increase the opportunity cost of holding physical metal without coupon payments, forcing a rotation back into bonds or stocks if growth remains resilient. For investors, this suggests that chasing current levels may be premature and exposes portfolios to sharp drawdowns if the dollar strengthens further on fresh data releases ahead. We should anticipate increased unpredictable price swings rather than smooth gains moving forward from here, as markets digest conflicting signals between domestic economic strength and a safe place to store wealth demand. On to stock market outlook. Bitcoin stabilized near $64,000, while Ethereum climbed 0.4% to $1,880, signaling renewed confidence among major digital assets. Solana surged 0.9% on heavy trading volume, driven by anticipated network upgrades and growing institutional interest in high-speed infrastructure projects. Conversely, XRP remained largely flat with only tiny gains, reflecting lingering regulatory uncertainty that continues to dampen investor enthusiasm for this specific asset class despite its historical resilience during previous market corrections, when legal clarity improved investor mood. Rapidly across the sector, the current quietude represents a critical pause, where markets are holding their breath ahead of Wednesday's Federal Reserve decision, widely viewed as the definitive trigger, capable of settling whether crypto's recent bottom is genuine or merely a temporary reprieve before another leg down begins. Soon after that pivotal moment arrives next week. Ethereum outpaced Bitcoin slightly today, demonstrating distinct strength in altcoins even amidst broader caution regarding big-picture economic challenges and potential available cash in the market raising interest rates from central banks globally. This divergence mirrors historical patterns seen during the 2018 bear market recovery phase, when smaller cap tokens rallied harder than large caps once regulatory overhangs cleared, and institutional capital began rotating into higher beta opportunities, seeking asymmetric returns in a risk-seeking environment, suggesting investors should closely monitor balance sheet adjustments before deploying fresh capital into volatile digital assets this coming week. Let's wrap up with what to watch next week. The S&P 500 closed virtually flat on Friday, caught between the shadow of escalating Iran tensions and a sharp correction in semiconductor, how expensive assets look relative to earnings. Meanwhile, the Nasdaq slipped by 6/4, while the Dow managed a modest recovery following one of Wall Street's most volatile weeks to date. The primary driver behind this broad-based decline was not merely bad news, but a fundamental shift in growth expectations that has rippled through global markets for over 2 decades. Big tech stocks tumbled severely after earnings reports failed to meet lofty analyst projections. Companies like Alphabet, Tesla, Microsoft, Meta, Apple, and Amazon all saw their shares fall overnight. This wasn't isolated disappointment, but a synchronized sell-off triggered by disappointing forward company outlook or revenue growth that fell short of expectations across multiple sectors simultaneously right now. Historically, such simultaneous misses often signal the end of an earnings cycle's upswing, prompting investors to rotate out of high-valuation growth names into defensive assets as uncertainty rises. For the prudent investor, this environment demands a recalibration. Reduce exposure to mega-cap tech where margins are compressing, and prioritize capital preservation until clarity returns on global economic stability and global political risks that could further disrupt supply chains or consumer spending patterns in coming quarters. Finally, let's turn to what to watch next week. The Federal Reserve stands poised for one of its most volatile meetings in recent memory as crude oil prices surge to new highs today, dramatically reshaping the probability landscape for a rate increase. Market participants are intensely focused on Wednesday's decision, with experts now predicting a significant hike rather than an expected pause. This shift occurs because soaring energy costs threaten to reignite inflation expectations just as policymakers sought stability. The mechanism at play is straightforward yet potent. Higher oil prices directly feed into consumer price indices, forcing the Fed to tighten central bank policy sooner than anticipated to anchor long-term inflation targets. If rates rise unexpectedly this week, second-order effects will ripple instantly through global markets. We could see a sharp correction in risk assets like stocks and cryptocurrencies as borrowing costs climb, dampening corporate earnings forecasts and cooling investment appetite. Historically, such surprise-raising interest rate cycles have often triggered immediate unpredictable price swings similar to the 2018 period, when aggressive hikes caused widespread sell-offs before eventually stabilizing growth. For investors, the implication is clear. Defensive positioning becomes paramount ahead of Wednesday's announcement. Those holding leveraged positions in crypto or high-dividend stocks must prepare for potential available cash in the market squeezes if the Fed pivots toward aggression. The outcome will not just dictate asset class performance, but could redefine the entire investment thesis for Q3 and beyond, making this single meeting a pivotal turning point that demands rigorous preparation rather than passive observation. Markets are coiled tight before the big policy move on Wednesday settles whether we get a rate hike or pause. Bitcoin holds near $64,000, while oil crashes to $96. That split means your safe place, and fuel costs are doing opposite things right now. Gold climbed despite yield pressure, but real yield staying above 4.5% keeps it in check until they cool down significantly again next month. Airlines face rising risks if crude stays near $100 per barrel, without relief from demand-side growth slowing down unexpectedly somewhere else globally first thing Monday morning, after weekend trading closes completely shut worldwide tomorrow. Thanks for watching Market Pulse Daily.